Since 2022, when we weaponized the dollar, central banks have effectively tripled their gold buying in just the last few years. You don't need to be a gold bug to see the direction of the hockey puck here. Gold is replacing the US Treasury as a settlement asset, as a savings asset, as a tier one strategic reserve asset. That should not be the apologies of a gold executive in Switzerland or me selling my book. That should be very clear to any listener that this crisis in the Treasury and the sovereign bonds, this crisis in the currency, this unloved, distrusted US Treasury is a crisis of debt, which is a crisis of credit and a crisis of liquidity from my opening point. It's all tied together, and every string we pull on, whether it's tariffs, whether it's Doge, whether it's Greenland, whether it's Panama, whether it's the BRICS, everything is tied to this simple fact of a credit liquidity crisis, which is a derivative of a debt crisis.
In early March, just as some traders were bracing for a short-term inflation shock from U.S.-imposed tariffs, the Deutsche Bank strategist warned that the greenback may lose its reputation as a safe haven currency, citing a declining correlation between the currency and stocks. Central bank attitudes toward gold started changing following the 1997 Asian financial crisis and the 2007 and 2008 financial crisis. Since 2010, central banks have been net buyers of gold annually. Renowned financial strategist Matthew Piepenburg notes that central banks have been net gold buyers and US Treasuries sellers. He emphasizes gold's growing role as a reserve asset, especially after the BIS classified it as a Tier 1 asset. Not all storms make noise. Piepenburg highlights a silent, systemic shift beneath market headlines. He points to America's ballooning debt and weakening global sway, predicting BRICS nations like China will push back creatively. The People's Bank of China has added gold to its reserves for 17 consecutive months, signaling strong long-term confidence in precious metals over U.S. government debt. As of early 2025, China holds less than $800 billion in treasuries, the lowest level in over a decade. By buying gold and selling treasuries, China appears to safeguard itself against potential geopolitical risks, currency devaluation, and rising U.S. debt levels. While reflecting on the fundamentals of the market, Piepenburg warns that the U.S. will escape its debt spiral only through more debt, funded by inflationary mouse-click money. According to him, gold's rise is an illusion. It's the U.S. dollar that's falling, having lost 99% of its value against gold. Since mid-January, the dollar has fallen 9% against a basket of currencies, a rare and steep decline to its lowest level in 3 years. Many investors spooked by Trump don't think the dollar will be pushed quickly from its position as the world's reserve currency. Instead, they expect a slower decline. But even that is scary enough, given the benefits that would be lost. Before we discuss Matthew Piepenburg's sharp insights from his latest interview, make sure to hit the subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
It'll be very interesting to see in the next 3 or 4 weeks, 3 or 4 hours, 3 or 4 minutes, what new changes in the tariff announcements happen, because it's creating so much uncertainty. But what is absolutely certain is our debt levels are too high. We're not the country we used to be. The world will probably not bend to our wishes as they did in 1971. And again, that's to be determined, but I highly believe that the BRICS and China in particular are going to become very creative. And again, I'm not saying that China takes over the world. China has massive problems. It has a massive debt crisis. It has a massive real estate crisis. It has a massive demographic crisis. 60% of its groundwater is rotten from all its manufacturing and pollution. It has to import its energy and import its food. So no, China's not just going to take over, and America's not going to disappear, but it won't be the same America it was 10 years ago in the next 10 years. That to me is undeniable. And I think it's going to be very important for people who are listening to get past just bond market volatility, stock market volatility, and look at history. You know, you had the Dutch Empire, you had the Habsburg Spanish Empire, you had the British Empire, and we have the US Empire for the last many generations. All of those currencies, all of those countries, all of those empires ended because of overextended wars, overextended debt, and debased currency, without exception. The US is no exception to that. But it wasn't the end of the UK. It was just the end of the British Empire. It wasn't the end of Spain. It was just the end of that empire. It wasn't the end of the Netherlands. It was just the end of that currency and that Dutch empire. Things change. There are fourth turnings. Empires live about 250 years, which is ironically where we're at. America's changing. It's not dying. And this market is volatile. It is, it is a bug looking for a windshield. Will this be it? I don't know. Other things I look at. But I do know that the only way out of a debt crisis for us is more debt, paid for by mouse click money, which is inherently inflationary, inherently currency debasing. Again, true in every empire's decline. And that explains why gold is rising at such a systemic level, because gold is doing one thing very well: it's holding its value. And gold is in a bull market because fiat money in general and the US dollar is in a clear, undeniably debt-driven bear market. And so gold only has one secular direction, not that it goes up in a straight line. It's very clear why gold is rising. It's not just because US Treasuries and US dollars and other fiat money is becoming more and more pathetic. The US dollar has lost 99% of its purchasing power measured against gold since 1971. Gold wasn't doing anything. The dollar was just getting weaker. And that's why the BIS has made gold a tier one asset. No one talks about it. A tier one asset alongside the US Treasury. It's a far better strategic reserve asset than US Treasuries. That's why central banks have been net stacking gold and net dumping US Treasuries since 2014. And since 2022, when we weaponized the dollar, central banks have effectively tripled their gold buying in just the last few years. You don't need to be a gold bug to see the direction of the hockey puck here. Gold is replacing the US Treasury as a settlement asset, as a savings asset, as a tier one strategic reserve asset. That should not be the apologies of a gold executive in Switzerland or me selling my book. That should be very clear to any listener, that this crisis in the Treasury and the sovereign bonds, this crisis in the currency, this unloved, distrusted US Treasury is a crisis of debt, which is a crisis of credit and a crisis of liquidity. From my opening point, it's all tied together, and every string we pull on, whether it's tariffs, whether it's Doge, whether it's Greenland, whether it's Panama, whether it's the BRICS, everything is tied to this simple fact of a credit liquidity crisis, which is a derivative of a debt crisis.
In his assessment, Matthew Piepenburg explains that Trump's tariff policies are not random chaos, but a deliberate economic shock to revive US dollar dominance, similar to Nixon's gold decoupling in 1971. He says the real target is China, the core threat within BRICS, as it leads a global shift away from the dollar. When asked about Treasury Secretary Scott Bessent's remarks earlier in the day, Trump commented that the high tariff rates between the United States and China have effectively embargoed trade between the economies. Bessent said at a private investment conference hosted by J.P. Morgan Chase that the trade war with China is unsustainable and expects the battle to de-escalate soon. A person familiar with the matter confirmed to CNN. United States President Donald Trump has reiterated his intention to lower his crippling tariffs on China, but insisted the timeline for any relief will depend on Beijing. While the administration hopes to isolate China and reshore U.S. manufacturing, Piepenburg believes they may be underestimating BRICS nations' resolve and creativity in resisting a return to dollar hegemony. Let's get back to the interview.
Whether you love or hate Trump, and that's irrelevant at this point. Some think he's a mad genius, some think he's just mad, some think he's an absolute disaster, some think he's actually a strong realist. There's no point in debating that because he's here. And so certainly no one cares about my political views. But let's just play it out as it really is happening right now with the tariffs. In my opinion, certainly whatever you think of Trump, Bessent, his Secretary of Treasury, has a pretty solid understanding of financial markets, the dollar, even gold, and debt. He's far more transparent about debt than Yellen was. And we have a White House that's far more active than the Biden White House. Again, all these executive orders, all these policies, which some people just think is shooting at the hip, just crazy. For the sake of being a devil's advocate, and again, there's a lot of criticisms of Trump policies, which we can get into, but I think you have to look at through a lens that there is a certain method to his madness. With the tariffs, this is a deliberate policy shock, like we saw in 1971 when we decoupled from gold, because Nixon was desperate to get dollar hegemony back. And ironically, part of that in his trips to China was to get China closer to the U.S. and away from Russia, or then the Soviet Union. What we're seeing in 2025 is a similar policy-induced shock to the global markets, to the U.S. markets, and to the global trade, obviously. But it's very deliberate. Because like in 1971, 2025 is an era of desperation, of an unloved dollar, of a de-dollarizing world, and a sense that we need to do something quickly. So the tariffs are clearly directed towards reshoring jobs, making the American dollar hegemonic again. And all of that has to do with the fear of China, in my opinion. The BRICS are many countries, but it's the C in BRICS, which is 17% of global GDP, which is really what concerns the Trump administration and the individuals around him. China is the actual threat. And you have to understand China is more of a threat now post 2022 in a weaponized dollar because China is part of this group spearheading a movement away from the US dollar. Again, 30 countries have repatriated their gold outside within their own borders outside of the U.S. and other systems. You've got 45 nations trading outside of the U.S. dollar, net settling in gold. You've got the oil trade, which was once sacred to the petrodollar, that you needed to buy oil in U.S. dollars. That created a great deal of dollar love and demand. That's weaning away slowly. 20% of global oil sales outside the U.S. dollar. China buying oil from Russia and paying for that in yuan. Believe me, everyone at Trump and certainly Bessent in those conversations sees the writing on the wall. And now they think is the time to act because we have to do something dramatic to get that dollar more attractive, more loved, get China weaker. And if you notice when these tariffs came out, there was this baseline tariff and there were 20% tariffs against the EU. There were specific tariffs against Mexico and Canada, and obviously massive triple-digit tariffs against China. In my view, it was very coordinated, very deliberate. The real focus was China. And you'll notice even when he backtracked, and we can talk about why he backtracked with his 90-day pause on the tariffs for other nations, but not China, it's still directed towards China. Even you could argue the tariffs directed toward Mexico and Canada are really directed toward China as well, because Bessent and others know that if you basically create a wall between China and U.S., you put this huge tariff on Chinese imports, China will just go into Mexico or Canada, sell there, and then those products can come up through the borders with lesser tariffs. I think one of the reasons he paused is, this is typical Trump bull in a China shop negotiation tactics, but he wants to go back to Mexico and back to Canada and make sure they negotiate that whatever we do to lessen your tariff burdens in Mexico or in Canada, please understand we're drawing the line with China. There's not going to be any secret movements of Chinese goods through Canada or Mexico back into the U.S. And we're not backing down on China. Again, the idea is to weaken Chinese influence. The idea is we are going to do a seismic shift in geopolitical trade. We're going to isolate China. We're going to make the dollar, we're going to force the dollar to be in more demand. We're going to force U.S. manufacturing that was now outsourced to China to come back into the U.S. You could argue all of those things make sense to make America great again, which is more about making the dollar hegemonic again. That's the best case scenario that kind of explains Trump's policies. The problem is, I think they underestimate China's ability to become creative and in the BRICS ability to continue to resist these trade sanctions and to resist this hegemonic policy shock for the dollar. The BRICS are many things, but they're not stupid. They've seen the writing on the wall for generations. They do want to get away from the dollar. They don't want to be under the seigniorage of U.S. dollar. They don't want to be under the seigniorage of the Fed policies, rate hikes, balance sheet expansion, cost effects, basically importing U.S. inflation. They don't want to be under the arms of usurious loans from the IMF or the World Bank. They're not coming back to a hegemonic dollar scenario. They're not going to come back willingly. Trump thinks he can force them back through these tariffs. The question is he underestimating them?
With the recent trade turmoil driving investors to safe havens, gold prices have been on a tear while competing assets such as the US Treasuries and the dollar have tumbled. JP Morgan expects the yellow metal to average $3,675 per ounce by the fourth quarter of 2025 and reach $4,000 by the second quarter of 2026. If the world is indeed pivoting away from dollar dominance, how prepared are individual investors and even nations for this financial reset? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.